Hello, I'm Madani Ariyam. In this video, I'm going to talk about what is equity and how it works in business. Equity is the book value of a shareholder capital. The accounting equation tells you that assets equal liabilities plus equity. That also means the equity equals assets minus the liabilities. The equity on the balance sheet of a company can go up or down. It can fluctuate. The calculation of equity is a company's total assets minus its total liabilities and is essential because it's used in several key financial ratios. Equity calculated for accounting purposes by subtracting liabilities from the value of an asset. For example, if I tell you an example, if you have 100 shares in a company, your equity in that company is the 100 shares. That is your equity in the company. Say you are having a house, it's worth about 800,000. And you owe the company 75,000. Value of the house is $100,000 and you owe the bank $75,000. So your equity on that house is 25,000. That's how it calculates. Equity calculated for accounting purposes. Equity is the book value of a shareholder capital. I've told you about it. The accounting equation tells you that assets equal liabilities plus equity. That also means the equity equals assets minus liabilities. The equity on the balance sheet of a company can go up or down. Besides, determining the value of a company, equity is essential to businesses because it helps finance expansion. If you don't know the equity of say you are running a business, if you don't know the equity of your company, you can't expand your business. You don't know how much profit, how much asset you have, how much equity you have. That is the assets minus your liabilities. Funding business expansion by selling shares of a stock to investors is equity financing. What is equity financing? Is funding business expansion by selling shares of stock to investors. When a company sells shares, it sells equity to investors for cash that it can use to fund the growth. Many small business owners invest their own money to help to set up the business as the capital. According to one study, 77% of small business rely on their own savings for initial funding. They can't go anywhere because they need to prove that they are setting up the business. What is business equity? What is equity in business? Business equity, value of assets after deducting your business liabilities. As a business owner, you have the right to all items of value within your company. Besides, take responsibility for your liabilities. You have to have responsibility. You can't ignore liability. Measure your equity by looking at the relationship between business assets and liabilities. Your assets are items of value such as property, land and buildings, cash in the bank, cash in hand, and machineries, all the tangible assets. It is the tangible assets are physical things that you can touch. That's what it means, like a building. On the other hand, intangible assets you can't touch. It's like goodwill, copyrights, and receivable from the customers, the accounts receivable from the customers, Brand and goodwill are these are all intangible assets, but you can't touch them. Liabilities are debts your business owes to another company, organization, employee, vendor, or agency. Typically, you incur these debts through regular business operations. Yes. When you operate in the business, you incur these liabilities. When your income more liabilities, your equity decreases. When you incur more liabilities, your equity decreases. When your liabilities is less than the income, when your income is more than your liabilities, then the equity increases. When your business's total equity is a positive number, you have more assets than liabilities. Moreover, more investments mean your business is gaining value. Equity can also be a negative number. Yes, if the liabilities are more than the assets, it's a negative number. When your equity is negative, you have more liabilities than assets, and your business less value. Business loses value. Calculating business equity. To calculate small business equity, use the basic accounting functions, accounting equation. Equity is equal to assets minus liabilities. After you calculate your own equity, report it on your balance sheet. You can also utilize the formula to determine how much you need to have in assets or liabilities to reach an equity goal. In addition to calculate equity, the accounting equation is possible to use to determine your total assets or liabilities by rearranging the equation formula. Assets is equal to liabilities plus equity. Liabilities equal to assets minus equity. You can put in any form the formula to calculate what you want. The value of equity usually appears in the balance sheet of your company. Yes. When you're doing the profit and loss account, the profit for the year, then the equity, that is the amount left over from previous years, is added to the balance sheet. Okay, thank you very much for watching my video. If you like it, please share it as well and subscribe to my channel as well. Thank you for watching my video. If you are a small business owner, this is very useful, I think. Yes. Thank you.